stock market crash sounds terrifying, right? The headlines scream disaster. Investors panic sell. People talk about losing everything overnight. But what if I told you that's exactly the moment some people make the most money? See, the wealthiest investors don't freak out when the market tanks. They buy. They see crashes not as a catastrophe, but as an opportunity. A massive opportunity. And here's the wild part. This isn't just for billionaires. You, yes you, can take advantage of a market crash too, but only if you know what to look for. So, how does it work? How do you actually turn a downturn into a once-in-a-lifetime chance to build wealth? Let's break it down. Most people see a market crash as a disaster. Stocks are down 20%, 30%, even 50%, and it feels like the economy is falling apart. But the truth is, market crashes are when the best opportunities show up. Think about it. If you walked into your favorite store and saw everything was 50% off, you'd probably buy more, right? Well, that's exactly how the stock market works. When stocks crash, they're on sale. High-quality companies that were once too expensive suddenly become bargains. And if you buy these stocks when everyone else is panicking, you can set yourself up for massive gains when the market recovers. Just look at history. After the 2008 financial crisis, stocks hit rock bottom in early 2009. But within a few years, they had skyrocketed to new all-time highs. The same thing happened after the COVID crash in 2020. Stocks tanked, but those who bought at the bottom made massive profits in just a few months. The lesson is clear. Market crashes create millionaires, but only for the people who know how to take advantage of them. The first rule of getting rich during a market crash is simple. Don't panic. This is the moment where most investors make their biggest mistake. They watch the stock market plummet, see their portfolio shrink before their eyes, and immediately go into full panic mode. Fear takes over, and their first instinct is to sell everything before things get worse. But this is exactly what you shouldn't do. Selling during a crash locks in your losses and prevents you from benefiting when the market inevitably rebounds. The stock market has a long history of crashes, corrections, and bear markets, yet it has always recovered and reached new highs. The Great Depression, the 2008 financial crisis, and the COVID crash in 2020 were all devastating at the time, but those who stayed invested, or better yet, bought more at low prices, made a fortune when the market bounced back. The key to surviving a crash and coming out richer is to stay calm and have a plan. Instead of reacting emotionally, think logically and prepare in advance. Before a crash even happens, create a watch list of strong, reliable stocks or assets that you believe in for the long term. When stock prices drop, you won't be making rushed, emotional decisions. You'll already know which investments are worth buying. This strategy ensures that when panic takes over the market, you're not scrambling or second-guessing yourself. Instead, you'll be in a prime position to capitalize on the fear of others and make calculated moves that could make you significantly wealthier in the future. Market crashes don't last forever. History shows that they are just temporary dips in a long-term upward trend. The investors who recognize this and hold their ground, or better yet, buy more, are the ones who come out ahead. The real winners in investing are the ones who see opportunity when others see disaster. So when the market starts collapsing, don't let fear control your decisions. Stick to your strategy, trust in the market's recovery, and take advantage of the chaos instead of becoming a victim of it. Not all stocks are worth buying during a market crash. While some companies will recover and thrive, others will never bounce back, and some might even go bankrupt. This is why it's absolutely crucial to be selective about where you put your money. A market crash isn't just a chance to buy stocks at a discount, it's also a time when weak businesses get exposed. Many companies that seemed promising during a bull market suddenly collapse when economic conditions turn harsh. So, instead of blindly buying any stock that's fallen in price, focus on high-quality businesses with strong fundamentals and long-term staying power. The first thing to look for is profitability. Avoid companies that are just burning through cash with no clear path to making money. A stock might look cheap during a crash, but if the company itself is fundamentally weak, that cheap stock could eventually go to zero. Instead, focus on businesses that are already profitable, generate consistent revenue, and have a proven track record of success. These companies are much more likely to survive and rebound after the market recovers. Another important factor is market leadership. Companies that dominate their industries tend to come out of crashes even stronger. Look for businesses with strong brands, loyal customers, and a competitive edge that sets them apart from their rivals. These are the companies that have the power to adapt, cut costs, and find new ways to grow even in tough economic times. Financial stability is also key. Companies that are drowning in debt or struggling just to survive are at high risk of failure when the market crashes. On the other hand, businesses with healthy balance sheets, strong cash reserves, and low debt levels are much better positioned to weather the storm. They can continue operations without needing to raise emergency funds or take on more debt at unfavorable terms. Some great examples of companies that meet these criteria are Apple, Microsoft, Amazon, and Google. These tech giants have survived multiple crashes and have consistently bounced back stronger. Their business models are built on innovation, recurring revenue, and massive global demand, making them resilient even in economic downturns. During a crash, some industries get hit way harder than others. Airlines, luxury brands, and tech startups usually take a beating. But some businesses actually thrive during recessions. These are the kind of investments that can protect your wealth and even make you money while the market is down. Some recession-proof industries include consumer staples, which are companies that sell essential goods like food, cleaning products, and healthcare supplies. These include major brands like Coca-Cola, Procter & Gamble, and Johnson & Johnson. Another safe bet is discount retailers. When the economy tanks, people start shopping at discount stores like Walmart and Dollar General, making these stocks more stable during downturns. Utility stocks are another great option since people still need electricity, water, and internet no matter how bad the economy gets. Companies like Duke Energy and NextEra Energy tend to perform well even in rough times. Finally, gold and precious metals are classic safe haven assets that investors flock to when everything else is crashing. By diversifying your investments and including some recession-proof stocks or assets, you can keep your portfolio stable even when the economy is in freefall. One of the hardest things about investing during a market crash is actually pulling the trigger and buying stocks. When everyone around you is panicking and saying, "This time is different," it's easy to hesitate. But that's exactly why you need to stay disciplined. The best strategy is dollar cost averaging. This means investing a set amount of money at regular intervals, no matter what the market is doing. If stocks keep dropping, you're buying more shares at lower prices. If they start recovering, you're still benefiting from the gains. This takes the guesswork out of timing the market and helps you build long-term wealth. History shows that the people who buy during market crashes end up winning big. Just ask Warren Buffett, one of the greatest investors of all time. His famous quote says it all: "Be fearful when others are greedy, and greedy when others are fearful. When everyone else is scared, that's your chance to buy." The biggest mistake people make during a crash is obsessing over short-term losses. It's easy to get caught up in the daily swings of the market, but that's a recipe for emotional investing. Emotional investing usually leads to bad decisions. Instead of worrying about short-term drops, focus on the long-term picture. The stock market has crashed many times before, and every single time it has recovered and hit new highs. The Great Depression, the 2008 financial crisis, the COVID crash, every time the market bounced back. If you invest in great companies and hold on for the long haul, history is on your side. The key is patience and discipline. If you stay committed, ignore the noise, and trust in the long-term power of the market, you can come out of a crash in a far stronger financial position than you ever thought possible. The next market crash is coming. Maybe not today, maybe not tomorrow, but eventually the market will go through another downturn. The question is, will you be ready? Most people will panic. They'll sell at the bottom, miss the recovery, and complain about how unfair the market is. But the smart investors, the ones who stay calm, buy great stocks at a discount, and hold on through the storm, will come out richer than ever. Market crashes are not disasters. They're opportunities. The next time stocks tank, don't run away. Run toward the opportunity. If you play it right, a market crash could be the moment that changes your financial future forever. The only question is, will you have the courage to take action when the time comes? Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comments section.